ladies and gentlemen, welcome to another stream here on your favorite, hopefully favorite, financial YouTube channel. And obviously, while you were enjoying your weekend, I was researching a lot of stuff. Okay, I was reading a lot. I was looking into a special of things that I want to share with you. I think that this is very important because those situations on the markets are quite special, right? Every day, every month, every year you have special situations on the stock markets. Never been the same. History never repeat, but it rhymes itself, like people like to say, right? There is a question in the comments from Czech. By the way, let me know in the comments where you are watching from. Was the name where there's the scene that I play? Yeah, I was right, and I got the bonus check. This is basically by the movie of The Big Short. I can really recommend it to you. Let me show you The Big Short and the scene. I will play the scene in a second. So this is the movie, The Big Short, with one of my favorite some of my favorite actors like Christian Bale, Steve Carell, Ryan Gosling, Brad Pitt. In a very, very sarcastic way, sometimes very comedic, in a very special way. So I really like this movie. So make sure to have a look. Let's start with some simple stuff. Okay, so the stock market on Friday had a little bit of a recovery or a rally towards the end. As you can see here, the S&P 500 gained 2.4%, which was not so bad. But on Monday we saw a big, I don't want to say crash because I don't want to give you this crazy word of crash, because it's just a correction in a bear market if you want, but I feel like some people are thinking, okay, this is just a small hiccup, I will buy the dip like I did a couple of times ago and it will work, right? Well, this time it's a little bit different because we are officially in a bear market, and I will show you which kind of rallies this is, because those rallies are quite special. But before we dive into that, let's have a look. We have people from West Lafayette in the US. We have people from UK. We have people from Paris. We have people, some people say they are from the moon, but I can't verify that. We have people from La Puente, California, with 2,500 shares at $15 at space. So not bad, Carlos. Very nice. We have people, from Prague as well. We have people from Norway. Thank you very much for tuning in. And David Stops is saying it's a bull trap. We have also Massachusetts and Boston in the house. So quite interesting where you guys are all from. Let me keep on going, okay? I will give you a shout out. So let us start with some basics. First, the scene that our friend, what was his name? Krerovec, I hope I said it right, was talking about.
So I was right. I took a rash of shit for 2 years, but I was right, and everyone was wrong. And yeah, I got a bonus check for it.
So yeah, if the weekend wouldn't be over yet, I would say, or maybe you still have a little bit of the weekend, watch this movie. It's a fantastic movie, The Big Short. Now, let's turn to the markets real quick, because, those rallies that you have seen are very typical for a bear market. They are very strong, sometimes very impulsive, and you can see that in a couple of examples. Okay, so here's, for example, example of bear market rallies in the S&P 500 in 2000 till 2003. This was the big .com crash, and you can see here that not only we had the small rallies every now and then, but we had those very big rallies here. For example, we had a rally of 20% in just a couple of days. This was like the May period, okay? Then we had September till beginning of what is it, of or until spring of 2002, a rally again of 20%, right? Then again it went down further until it recovered again 20%, right? So you have this rallies all over, and I will give you an example why I think the bear market will still continue. But let's talk about more about these rallies. You know, here for example you see this as well. So even though the S&P 500 went down, you can see here that from those lows we had those 19, 21, 21, 10%, 7%, 12% rallies. Okay, so these rallies are happening from now and then because the people say, oh, now it's the end, now I have to go in. Oh, now I'm getting greedy, I need to have you know, my FOMO covered, right? I go in. So those are the traps, you call them also, like our colleague here said rightly, we call them the bull market traps. And also here you can see with some days we have those bull this bear market rallies, you know, 9 days, 14 days, 12 days, 69 days, 26 days, 3 days, 4 days, 7 days, 46 days, 7 days, and so on and so forth. But overall bear markets, and let's have a look, average duration of bear markets are quite long, okay? So the average length of a bear market is 289 days, or about 9.6 months. So if we and I talk about this in one of my videos recently, I think in the video yesterday, so go and watch it. But it started with the Russell 2000, and I think that officially you can say that this bear market started here, okay, beginning of November. So if we're calling about, you know, 10 months, then we are talking about that we are still in the bear market until about September, just in time for space to finish their maintenance, right? So let's see, maybe we will see even $4 space. We don't know, okay? So coming to the question, to answer the title of this video, how the stocks could make tomorrow or do tomorrow, there's two facts. First, if this is a bear market rally as a reaction to the overall situation in this bear market, then maybe we see a couple of days. We saw the durations of this rallies, right, in the bear market. So maybe we have this, you know, 7, 8, 9, 14 days of a rally, and then we go further down. Or we see a longer, you know, a longer period now of maybe more downturns, because you have seen also those rallies can be also just 2 days or just 1 day. Okay, so there's another terminology, and it's basically true. You know, if you look at back tested you know, strategies on the stock market, actually showed that turnaround Tuesday. So if the Monday is red, the Tuesday is green in 65% or 66% of the cases, and the optimal play to play those turnaround Tuesdays is actually to hold those shorts or whatever you have then for about 5 days. Okay, so if you're looking into that, as well as Tesla, you know, we could either see tomorrow a continuation, or we can see tomorrow another bloody Monday, and then a turnaround Tuesday. Okay, so it's really a 50-50 chance here. There was not bad news over the weekend, right? I mean, the Russia and Ukraine situation didn't really, I would say, worsen over the weekend. This was like about, you know, a kind of, silent situation over the weekend because they agreed to talk about, I think, in 1 week or in 2 weeks time. So this is a little bit of a, you know, neutral situation. However, there is also a timeline for that, right? And people are saying that the market will crash if this will happen. If really Russia goes into Ukraine, then we can have a really big issue on the stock markets. This will very much drag all the stocks down in this kind of situation. Now, one question now preserves, right? How deep can we go? Okay, and I want to show you something, which is a chart actually of Apple. And this is the PE ratio. The PE ratio is the best, one of the best factors, right, to compare you know, how expensive is the stock, right? Because it compares earnings to the price, and then you have a relative number that you can compare. It doesn't matter from the timing. It's a nice comparable number. So, you know, Apple was for a very long time a very cheap stock with a PE ratio of just like 14, 20 max, 22 sometimes, and so on. Look at this. We, you know, in February 2019, we had a 14 PE on Apple, okay? And then this grow a little bit, then we were at you know, 17, 18, then we went down back to like 14, 15, then came the big, you know, bull run, right? And the stock had a PE ratio of 25, which was then a little bit more expensive. But then look what happened. Then the stock went down, and it went back to a PE ratio on March with the bottoms of the health crisis of 17. All right. And then you had pretty much the same PE ratio like you had back in the peaks of 2019 in the spring. But then what happened was everybody went into, you know, absolutely crazy buying mood, and the PE jumped to highest highs in September of 2020 at 40, guys, okay? And since then we went down. Now there's two questions, okay? The overall hype on stocks and everything seems to slow down because also the Fed will not pump so much money into the markets. People will try to save their money, their winnings, right? Because think about it. Now many people made a lot of money on the stock market, lot of money on the crypto market, and now the market goes down. So the people either buy the dip and lose all the gains, or they even, you know, go out completely of the market, right? They say, okay, you know, I got it, you know, I will go out of the market, save my gains. And the question here is now the following. Do we go down to a interesting PE ratio of 17, where we was in 2019, or do we go into the PE ratio of when the crisis hit the bottom at March 2020? Because think about it, is Apple now much more worth? I think yes. Okay, this is number one. I think Apple just showed the world that it's a fantastic company. It's really interesting. You know, what an interesting, superficial, super productive company it can be. Okay, so I think like the PE ratio of 17, it deserves more. Okay, let's put it this way: it deserves more. Now, all right, we have to look into the Fed rates. Okay. And as you can see here, for example, we were very much down. Can I zoom that in? Let's have a look. Open image in a new tab. There we go. Now we zoom a little bit in. And now you can see we were for a very long time at 0 interest rates, okay? Then we increased the interest rates to about 2. All right. This was somewhere in 2018 we started, and still the market went up, right? So the question is now, as we go higher with the interest rates, do we meet those levels again? Okay, so this 2018 levels, 2019 levels. So back in our PE chart, and I try to show it to you. So here, it's what's happened. Okay, once the Fed announced that it will raise rates, the market went further down until a PE ratio of 13. So we are somewhere from now 30 PE ratio till 13 PE ratio. Somewhere in between is a really great value for Apple. So there's the potential of a 50% decline of Apple. Now I said it's not really justified that Apple goes down to 13 or 17. However, I could imagine a bear market that drags Apple down to, for example, to a PE ratio of 20. Okay, this means that 1/3 of Apple could go still down. Okay, so that's my little bit of a logic here, trying to see where the stock of where the stock of market could go in this bear market. Okay, so I really try to make it as simple as possible. I hope you like it. And so tomorrow it's really a 50-50 chance if stocks go up and down, but definitely if it's going down, there is a much bigger chance that we have a turnaround Tuesday, 65% chance that we have a turnaround Tuesday. I'm quite excited. Those times are the best times actually, guys. Okay, I'll try to find one more quote that I will try to find. Okay, so here we go. So there's great let's say quotes on bear markets, like for example here, bull markets make you money, but bear markets make you rich. Okay, so this is quite interesting. But there's also another funny quote. I think there's a quote like that bear markets creates generational wealth, which I also like. Thank you very much for tuning in. As usual, make sure to smash the like button. And I will leave you here with Elon Musk dancing, and I hope you learned a lot. And share this if you find this interesting with friends, so they will have a proper idea what's going on the markets. And have a fantastic Sunday. I see you obviously tomorrow.